Book Snapshot.
Welcome back to Book Snapshot. I'm your host, and today we're diving into one of the most transformative books ever written about investing, The Intelligent Investor by Benjamin Graham. If you're serious about building wealth and understanding the stock market, this book is absolutely essential. Published in 1949, it's been called the Bible of Investing by none other than Warren Buffett himself, and for good reason. In the next 10 minutes, we're going to uncover the core principles that have made millionaires and shaped investment strategies for over 7 decades. So stick around, because what you learn today could fundamentally change how you approach your money. But before we dive in, don't forget to hit that subscribe button and turn on notifications so you never miss our book snapshots. Let's get started. Benjamin Graham wasn't just any investment advisor. He was a legendary figure in Wall Street history, and The Intelligent Investor represents decades of his wisdom distilled into practical guidance. The book's central thesis is simple yet profound. Successful investing isn't about beating the market or making quick profits. It's about adopting a disciplined, business-like approach to purchasing securities, buying them at a discount to their true value and holding them for the long term. Graham makes a crucial distinction right from the start. There's a massive difference between an investor and a speculator. A speculator bets on price movements, hoping to catch the next big wave. An investor, on the other hand, carefully analyzes a company's fundamentals, understands what they're buying, and only purchases when the price is significantly below the intrinsic value. Think of it this way: a speculator is gambling. An investor is thinking like a business owner. And Graham's entire philosophy is built around becoming that second type of person. The book is filled with real-world examples, historical data, and practical frameworks that you can apply to your portfolio today. But what makes it truly special is that Graham doesn't just tell you what to do. He teaches you how to think about investing in a way that protects you from making emotional, costly mistakes. Now, let's talk about what might be Graham's most important contribution to investing philosophy: the margin of safety. Imagine you're buying a house. The asking price is $1 million, but after a thorough inspection and market analysis, you determine it's actually worth $1.2 million. Would you pay the asking price? Probably not. You'd want a discount, maybe 20 or 30% off, to give yourself a cushion in case your valuation is wrong or the market shifts. That's the margin of safety in action. Graham argues that this principle should guide every investment decision. You should only buy a stock when it's trading significantly below its calculated intrinsic value. This discount acts as your insurance policy. If your analysis is slightly off, or if the market temporarily declines, you're protected. This is why Graham emphasizes thorough research and analysis. You need to understand what you're buying. You need to read financial statements, understand the company's competitive position, and have a clear picture of its earning potential. Only then can you determine if a stock is trading at a true discount. The beauty of this approach is that it removes emotion from investing. You're not buying because everyone else is buying. You're not selling because the market is panicking. You're making rational, calculated decisions based on value. And historically, this approach has dramatically outperformed market averages. One of the most famous concepts in the book is what Graham calls Mr. Market. This is an allegory that perfectly captures how stock markets actually behave. Imagine you own a small business, and every single day, a character named Mr. Market shows up at your door with an offer to buy your business or sell you a similar one. The price he quotes changes constantly. Sometimes it's wildly high, sometimes it's absurdly low. His mood swings are dramatic. On good days, he's euphoric and offers premium prices. On bad days, he's depressed and offers pennies on the dollar. Here's the key insight. Mr. Market's mood has nothing to do with the actual value of the business. The business's fundamentals haven't changed. What's changed is Mr. Market's emotional state. The stock market works exactly the same way. Prices fluctuate wildly based on sentiment, fear, greed, and herd mentality, not necessarily based on changes in company value. When the market is euphoric, stocks become overpriced. When it's panicked, they become underpriced. Graham's advice? Use Mr. Market's irrationality to your advantage. When he's depressed and offering low prices, that's when intelligent investors buy. When he's euphoric and prices are inflated, intelligent investors sell or stay calm. You're not a slave to Mr. Market's moods. You're a rational business owner taking advantage of his emotional swings. This mindset shift alone can transform your investing results. Instead of being swept up in market hysteria, you become the calm, rational decision maker. So what does Graham recommend for the actual intelligent investor? How should you actually build your portfolio? Graham identifies two main types of intelligent investors: the defensive investor and the aggressive investor. Don't let the terminology fool you. Aggressive doesn't mean reckless. It just means more actively involved in stock picking. For the defensive investor, someone who wants a hands-off approach, Graham recommends a simple strategy. Divide your portfolio between high-quality bonds and a diversified selection of common stocks. The exact split depends on your risk tolerance, but something like 50-50 or 60-40 is reasonable. Then, stick with this allocation and rebalance periodically. That's it. No market timing. No trying to pick winners. Just consistent, disciplined investing. For the aggressive investor, someone willing to spend time researching companies, Graham recommends a more active approach. But even here, the principles remain the same. Buy quality companies at reasonable prices, maintain a margin of safety, and think like a business owner, not a trader. A crucial point Graham emphasizes is the importance of diversification. Don't put all your eggs in one basket. Spread your investments across different companies and industries. This reduces your risk without significantly reducing your potential returns. Graham also stresses the importance of understanding what you're buying. If you can't explain why you own a stock in simple terms, you probably shouldn't own it. This filters out a lot of noise and keeps you focused on quality investments. And here's something that might surprise you. Graham actually recommends that most people should invest in index funds or diversified mutual funds rather than trying to pick individual stocks. This was radical thinking in 1949, but it's proven to be incredibly wise advice. You might be thinking, this book was written in 1949. Is it still relevant today? The answer is absolutely yes. The principles Graham outlines are timeless because they're based on human psychology and fundamental business economics. Markets still swing between euphoria and panic. Companies still have intrinsic values that differ from their stock prices. And investors still make emotional mistakes that cost them money. In fact, Graham's teachings have become even more relevant in our modern era of algorithmic trading, social media-driven stock frenzies, and 24/7 financial news. The noise is louder than ever, which makes Graham's core message even more important. Focus on value, maintain discipline, and ignore the crowd. Warren Buffett, perhaps the world's most successful investor, has attributed much of his success to Graham's principles. Buffett has said that reading this book changed his life. He's applied Graham's framework for over 6 decades and has become a multi-billionaire in the process. But you don't need to become a billionaire to benefit from these ideas. Whether you're investing in individual stocks, index funds, or building a retirement portfolio, Graham's principles apply. Buy quality at reasonable prices. Maintain a margin of safety. Think long-term. Avoid emotional decisions. Diversify. These aren't just investment tips. They're a philosophy that can guide your financial life. The book also covers important topics like how to analyze financial statements, how to evaluate management quality, and how to think about inflation and its impact on investments. Each of these chapters is packed with practical wisdom. Let's recap the core lessons from The Intelligent Investor. First, adopt a business owner's mindset. You're not gambling on price movements. You're buying pieces of real businesses. Second, always demand a margin of safety. Never pay full price. Wait for discounts and buy when there's a cushion between price and value. Third, don't be swayed by Mr. Market's mood swings. Use market panic as an opportunity to buy and market euphoria as a time to be cautious. Fourth, think long-term. Graham's philosophy is about building wealth over decades, not making quick profits. Fifth, diversify your investments to reduce risk without sacrificing returns. And finally, if you're not willing to research companies thoroughly, invest in diversified index funds instead of trying to pick individual stocks. There's no shame in this approach. It's actually what Graham recommends for most people. These principles have stood the test of time because they work. They're not flashy or exciting, but they're proven. The Intelligent Investor is more than just a book about stocks and bonds. It's a masterclass in rational thinking, discipline, and long-term wealth building. Whether you're just starting your investing journey or you've been in the market for years, this book will change how you think about money. I highly recommend reading it yourself. The full book is packed with even more insights, historical examples, and practical frameworks that we couldn't cover in just 10 minutes. Now, I want to hear from you. Have you read The Intelligent Investor? What's your biggest takeaway from Graham's philosophy? Drop your thoughts in the comments below. I read every single comment and love hearing from our community. If you found this book snapshot valuable, please give this video a thumbs up. It helps us reach more people who are serious about improving their financial literacy. And if you haven't subscribed yet, now's the perfect time. We release new book snapshots every week, covering the most important books in finance, business, and personal development. Hit that subscribe button and turn on notifications so you never miss an episode. Thanks so much for watching, and I'll see you in the next book snapshot. Keep learning, keep investing, and remember, the best time to plant a tree was 20 years ago, but the second best time is today. Take care.